What if I told you that right now, at this exact moment in history, the most powerful wealth transfer in a generation is quietly happening, and most people are completely missing it? Gold just hit $5,150 per ounce. A year ago, it was under $3,000. That's a 77% gain in 12 months. And here's the part that nobody is talking about. This isn't a bubble. This isn't speculation. This is a system working exactly the way it was designed to work. And once you understand the mechanics behind it, you'll never look at gold or silver the same way again. Stay with me, because what I'm about to show you changes everything. Let's start with something that might surprise you. Most people think gold goes up because investors panic. And yeah, fear plays a role. But if that were the whole story, gold would spike for a week and then crash back down. That's not what's happening. Gold has been climbing for over a year, and the biggest financial institutions on the planet are still raising their price targets. Wells Fargo just set a year-end target of $6,100 to $6,300. UBS is calling for $6,200 by September, with potential upside to $7,200. Goldman Sachs raised its December forecast to $5,400. These aren't small players. These are the people who move markets. So why is gold doing this? What do they know that most people don't? The answer comes down to four forces that have converged at the same time, and this specific combination has only happened a handful of times in modern financial history. When all four hit together, gold doesn't just go up, it explodes. Force number one, and this is where most people's understanding of gold stops, is the dollar. Gold is priced in US dollars globally. So when the dollar weakens, gold automatically becomes cheaper for every buyer outside the United States. European investors, Chinese central banks, Indian households, Middle Eastern sovereign wealth funds. When the price drops in their currency, demand surges. And right now, the dollar has fallen roughly 10% over the past year. Morgan Stanley's currency team believes it could fall another 11% over the next 12 months. Why? Because the United States is running a fiscal deficit of over $2 trillion per year. The national debt is approaching $37 trillion. And here's the number that should genuinely concern you. The interest payments on that debt are now larger than the entire U.S. defense budget. Global investors are looking at those numbers and moving capital out of dollar-denominated assets. And where does that capital go? You already know the answer. But here's where it gets even more interesting, because dollar weakness is just the beginning. Force number two is something called the real interest rate, and this single variable explains more about gold's price movements than anything else. I know that sounds technical, but stay with me for 60 seconds because this is the thing that Wall Street absolutely does not want retail investors to understand clearly. A real interest rate is just the return on your money minus inflation. When that number is positive and high, when your savings account or bond actually beats inflation, gold suffers. Why would you hold something that pays you nothing when your bond is making you real money? You wouldn't. And gold traders know that. But flip the script. When real rates are low, zero, or negative, when your bond return doesn't even cover your cost of living, suddenly a metal that has held its value for 5,000 years looks extremely attractive. That's exactly what happened throughout 2025. The Fed cut rates 3 consecutive times in September, October, and December. Real rates collapsed, and gold went from $2,600 to $4,000 to $5,000 and beyond. This is not a coincidence. This is cause and effect. And the structural fiscal pressure on the U.S. means this dynamic is unlikely to reverse cleanly, even if the new Fed chair Kevin Warsh tries to maintain a tough stance on rates. The math of U.S. debt doesn't care about a hawkish Fed chair. Now keep that in mind, because in a moment, I'm going to tell you what this means for silver specifically, and the number will shock you. Force number 3 is what analysts call the geopolitical risk premium. And before you tune out and say, yeah, world is uncertain, gold goes up, we've heard this. Let me give you the actual data, because the scale of what happened in early 2026 is genuinely extraordinary. The World Gold Council's models show that geopolitical risk alone accounted for roughly 12 percentage points of gold's year-to-date return through early 2026. That is not background noise, that is a major driver. Flashpoints from Greenland and Venezuela to the Middle East reinforced gold's appeal as a hedge against the kind of uncertainty that no stock portfolio can absorb. Trump's unpredictability around tariffs, sanctions, and foreign policy created exactly the environment where institutional investors don't want overexposure to any single country's political outcome. And here's the critical thing that makes gold different from every other asset in this situation. Gold has no counterparty risk. No government has to honor it. No corporation has to stay solvent for it to hold value. When the entire system feels unreliable, gold is the one asset that doesn't need the system to function. That's not marketing copy. That's 5,000 years of financial history. But force number 4, this is the one that changes everything. This is the one that turns a temporary gold rally into a structural, multi-year megatrend. And most people have no idea this is happening at the scale it's happening. Central banks around the world are buying gold at a pace that has never been seen before in modern history. Not slightly elevated, not modestly higher. Central bank purchases since 2022 have been more than twice the 2015 to 2019 average. Their share of total gold demand has risen to nearly 25%, up from just 12% in the prior period. Goldman Sachs estimates central banks are now buying around 60 tons of gold per month. Before 2022, the average was 17 tons. China, India, Turkey, the biggest emerging market central banks are all moving systematically out of dollar reserves and into gold. This is de-dollarization, not as a talking point, as a balance sheet decision. And the critical thing to understand about central bank buying, unlike a retail investor or a hedge fund, they don't panic sell when prices dip. They buy consistently, month after month, quarter after quarter. That creates a structural floor under gold that has permanently changed the supply-demand equation. Let that sink in for a second. The floor under gold is higher now than it has ever been, not because of sentiment, but because of institutional buyers with multi-decade time horizons. Now, silver. Because if what's happening in gold is a wave, what's building in silver is a tsunami, and it's coming from a direction most people aren't even watching. Everything driving gold is also driving silver. Dollar weakness, falling real rates, geopolitical hedging, central bank interest. Silver responds to all of it. But silver has a second engine that gold simply doesn't have, and that engine is roaring right now. Silver is an industrial metal, and the industries consuming it most aggressively are the two fastest growing sectors in the entire global economy: green energy and artificial intelligence. Solar photovoltaic manufacturers consumed over 25% of annual global silver supply in 2024 alone, and demand rose again in 2025. Every solar panel contains silver. There is no substitute that matches its electrical conductivity at the scale the industry needs. Now add AI. Data centers in the US have chosen solar energy as their primary power source, 5 times more than nuclear. And AI's demand for electricity is expected to grow 31% over the next decade. More solar panels, more silver. The feedback loop is direct and it doesn't stop. Here's the number that makes all of this concrete. The Silver Institute projects a 67 million ounce supply deficit in 2026. Even with increased recycling and record high total production, the market will need to draw down physical inventories just to meet demand. This is the 6th consecutive year of a structural supply deficit. You cannot run a physical commodity market in deficit for 6 straight years without the price eventually reflecting reality. And physical silver inventories at the COMEX and Shanghai vaults hit record lows in late 2025. When paper contracts collide with the inability to deliver actual metal, prices don't walk higher, they run. Now here's the number I promised you earlier that will make you stop and reread it. If silver were priced according to its production ratio relative to gold, and gold is at $5,000 per ounce, silver should be around $555 per ounce. It's currently at $83. The gold to silver ratio sits near 1 to 62. By one of the most fundamental measures of relative value in commodity markets, silver is one of the most undervalued assets on the planet right now. Silver surged 147% in 2025, its best annual performance in decades, and it still hasn't caught up to what the ratio says it should be worth. That's not a small gap, that's a canyon. And canyons don't stay open forever. And then China made a move that almost nobody covered properly. In January 2026, China tightened silver export licenses, squeezing global physical supply further and reinforcing the scarcity that was already building. If that policy holds or tightens, it could single-handedly flip the physical supply balance in Western markets and force prices sharply higher with very little warning. So where does this all go from here? What actually happens next? For gold, there are 2 realistic scenarios, and you need to know both of them. The bullish scenario, which the majority of institutional forecasters currently favor, is a U.S. economic slowdown that forces the new Fed chair to cut rates even against his instincts. Falling yields, continued dollar weakness, sustained geopolitical stress, and persistent central bank buying all converge. Under that scenario, the models point to gold testing between $5,900 and $6,700 per ounce. That's another 15 to 30% from here. The bear scenario is a Trump policy success story. Stronger than expected growth, inflation contained, the Fed holding firm or even hiking. That produces a correction of 5 to 20% from current levels. At today's price, that's a floor somewhere between $4,100 and $4,900. Still historically elevated by any prior standard, but painful for anyone who bought near the highs. For silver, the institutional forecast range for 2026 is the widest of any major commodity, from $42 per ounce at the cautious end to $309 at the most aggressive extreme. JP Morgan's base case is roughly $81, about where silver sits today. But that base case assumes no acceleration in investment demand, no major supply shock, and no new industrial breakthrough. Given everything we just covered, all three of those assumptions look fragile. The near-term technical levels that matter right now. $83 to $84 is the current battleground. $92 is the first major resistance on the upside. A close above that is the signal that the bull trend has fully resumed. Below $75, the bear case takes control, and the next meaningful support is near $65. Watch those levels, not because charts predict the future, but because enough institutional money watches the same levels that they become self-fulfilling. Here's the thing that most people will never stop to think about. The uncertainty that is driving gold higher right now, the fiscal deficits, the geopolitical fractures, the monetary system under stress, none of it is going away. The numbers that are making global investors nervous are getting larger, not smaller. The de-dollarization that is driving central bank gold buying is a decade-long structural shift that a single Fed chair cannot reverse. The industrial demand for silver from solar and AI is tied to the most durable trends in the global economy. Most people will watch gold go from $3,000 to $5,000 and think they missed it. Some people will understand that the conditions creating this move are still accelerating and act accordingly. The difference between those two groups isn't intelligence, it's understanding the mechanics. And now you do. So here's your question. You've seen the data, you understand the four forces, you know the silver setup. Where do you think gold closes in 2026? Drop your number in the comments. I want to see your thinking. Hit subscribe if this gave you a framework you didn't have before, and share this with one person who you think needs to understand what is happening in these markets right now. I'll see you in the next one.